Okay guys, so we're looking at the US Dollar Index, which is basically the dollar's performance against a basket of 6 currencies, which is made up of the Japanese yen, Canadian dollar, the euro, pound, the Swiss franc, and the Swedish krona, I believe. Now, most importantly, the dollar index is basically telling you how the dollar's performing versus the rest of the world. Is the dollar in a higher demand or a lower demand? If the dollar's in high demand, then the dollar index rises. If the dollar's in a lower demand, then the dollar index falls. So what did we see last year? We saw the dollar index really start to decrease after the Federal Reserve slashed interest rates around March of last year. Obviously, the pandemic hit the global economy, and then the Fed reduces interest rates from 1.75% down to the current range of 0 to 0.25%. So a dramatic cut in interest rates from January to March. And there's no surprise that it was after the rates got cut in the United States, the dollar really started to decline across the markets. Now, I've shown you why this is. I've shown you in previous videos about the carry trade rollover. So let's say, for an example, we're looking at the Mexican peso against the US dollar. So we can even see when we look at the USD Mexican peso that around March times is when the dollar really started to decline as interest rates got cut. So again, around this period of time when the rates were getting slashed in the US, this is when we saw the dollar really start to decrease in value. So why is this happening, and what's the fundamentals behind this situation? Well, it's really down to the carry trade rollover. And what that really means is you've got to remember, if I want to sell this currency pair, betting that the Mexican peso goes up in value against the US dollar, I'm obviously going to have to own US dollars first, and I'm using these US dollars to finance the purchase of the Mexican peso. So I own US dollars, I sell my dollars in exchange to buy Mexican pesos, then the Mexican peso goes up in value against the US dollar, then to close the trade, I sell my Mexican pesos back into US dollars, and now my Mexican pesos can buy more US dollars, and I'm left over with more or less US dollars than I started off with. And that's how you make money in a trade. So obviously, to trade an exchange rate, you have to own one currency, sell it in exchange to buy the other currency. So the currency that we're swapping, we call this the lending currency, and the currency we're buying, we call this the investment currency, okay? So you could also look at it in terms of the interest rates in a country. When we know that we borrow money from a bank or we deposit money at the bank, we have an interest rate attached to that. We have the deposit rate and the lending rate. So when you borrow money from a bank, you pay interest. When you deposit money at a bank in a savings account, you get paid interest. And obviously the difference in interest rates between two countries is going to have a big impact on the way the currency pair trades, because if I'm selling the Mexican peso against the US dollar and I'm selling this exchange rate, I'm obviously betting that the Mexican peso goes up in value against the US dollar. Now, the Mexican interest rate at the moment in Mexico is 4.49%. The interest rate in the United States is only 0.09%. So when I'm borrowing the US dollar to fund the purchase of the Mexican peso, I'm obviously paying the lending rate on the US dollars I'm borrowing, which is 0.09%. And when I buy the Mexican peso, I'm getting paid the deposit rate of 4.49% on the amount of Mexican pesos that I'm purchasing. Remember, this interest rate is over 365 days. So over a 12-month window, if I was to hold this trade and I was to sell this currency pair, it obviously pays me to buy the Mexican peso against the US dollar, because I get paid more interest on the Mexican pesos that I buy than I pay out an interest on the dollars that I'm borrowing to finance the purchase of the Mexican peso. So overall, I make 4.4% profit on this trade over an annual 12-month period. If I'm trading one lot, that means I'm getting paid 12 Mexican pesos per day in interest, which is good, okay? I'm making money overnight. If I'm buying the US dollar against the Mexican peso, I'm losing money overnight. I'm automatically in a negative interest rate carry, because the US interest rate is much lower than Mexican interest rate. So I'm only receiving 0.09% interest, but I'm paying out 4.49% interest. So it doesn't pay me any money to buy this currency pair. I'm losing money every single night. I'm losing $12 per day just to try to hold this trade. So obviously no investor is going to be buying the US dollar against other currencies with much higher interest rates unless there's a fundamental reason to be doing so. And at this moment in time, there's no fundamental reason to be buying the dollar against the peso for an example. So with you understanding that, that explains why the dollar got weaker against all currencies across the markets. The euro, for an example, you can see shot up against the dollar. The Aussie dollar, for an example, shot up against the US dollar, and pretty much every currency shot up against the dollar because it lost its attractiveness as an investment currency, because you're now losing money when you're buying the US dollar. So you could either trade the US dollar against specific exchange rates, or you can just understand that the dollar is at the moment in a structural bear trend, and you could just trade the dollar index. So what we can do is we have a technical trend line that's formed as the dollar's been getting weaker. This is our third retest. This is a perfect time now if we get a doji candle, for an example. If the market's basically run out of steam with the dollar having a pullback, as you always get pullbacks in price on the way down. If we get another pullback here and we get a retest and the markets then start to sell off again and we continue the downtrend, perfect time to jump in for a short sell position in the dollar index. And we can take this short sell down to the downside and we can try to make some profit, just understanding the fundamentals behind the dollar's weakness at this moment in time. So what we want to work out first of all is how much does the dollar index fluctuate by on a monthly basis. Then once we get that understanding, then we can look to take a short sell in this exchange rate mechanism that we can try to make a profit for. So this is something I do provide for my members in terms of ATR volatility stop loss areas. So how much as a percentage do we get into this trade? So if you are interested in following our trades and getting into these positions, you can join my trading team, where I'll be sharing with you my open trades and you can trade alongside me, as well as understanding why we're in the market, so on and so forth. But if we get a retest and we short sell to the downside, this is a perfect opportunity to jump in to this trade. So I hope that makes sense. That's a dollar index, a really good short sell at this moment in time. Thank you.